Hi, everyone. Welcome to our special guest presentation tonight. My name is David Kosmeter. I'm the creator of TimingResearch.com. If you've seen any of our weekly web shows, you've probably seen my guest tonight, Ed Carlson. He does a bunch of work based on the methodologies of George Lindsay, and he publishes a what he calls the Lindsay Report each month based on that. So tonight he is going to give us a little more in-depth information about that report that he publishes each month. And I'm going to go ahead and turn it over to him.
Thank you, David. Thank you, and good evening to everyone. I thought I would take advantage of this opportunity to speak, to talk a little bit, to give a little background on Lindsay. I really wasn't, I told David before we started, I really wasn't expecting this kind of turnout. And so I've got to believe that there's some kind of interest in the man as well as the methods. Quite frankly, the methods are involved enough that you're not going to learn them from this webinar. You'll get an idea as to what they're about. But I always like to say, it's like learning to play the piano. You can read about it all you want, but there's no excuse for actually sitting down and working on it. You know, you've got to practice. And it's not that it takes that much practice, but you just have to get a feel for this stuff. This was a very unique individual with some very unique methods. Lindsay was born in, I want to say 1906, died in 1987. He's well known for calling the bottom of the 20-year secular bear market that started in 1962 and ended in 1982. He was on Wall Street Week with Louis Rukeyser, for those of you that remember that program, in 1981, and called the end of the bear market within 2 weeks, a year in advance of that bottom. He also, in 1987, he wrote a letter in June of that year, calling the market crash in October later that year. Unfortunately, he failed to live that long. He died in, I want to say, July. But anyway, he was an interesting character. I have been studying his work now for 6 years, I guess. I've written 3 books. All of them are available at Amazon or through the website, seattletechnicaladvisors.com, as well as a handful of instructional DVDs for anybody that's interested in pursuing study of this work. Let's see here. I'm trying to read my own notes, my own handwriting. I'm sorry. Oh, okay. Right into the website. The website is called Seattle Technical Advisors. I publish daily, 5 days a week. 4 days of the week, I put out what's called a market commentary after the market closes. It's an abbreviated report just to bring everybody up to date on what happened that day. And then over the weekend, I write what's called a market update, and that's a full-blown report that comes out over the weekend, no later than Monday morning before they open, and trying to give some in-depth look at the markets, stock or equity, bond, commodity, and currency markets. That report contains both traditional technical analysis as well as the work of George Lindsay. However, once a month, I put out what's called the monthly Lindsay Report, and this is there's a little cycle work in it sometimes if it seems to be a good match, but for the most part, it's all Lindsay, and it's divided into two sections. One section, and probably for a lot of people, the section that holds the most interest is what I call the hybrid Lindsay model. This is my combination of my own traditional cycle work together with Lindsay's middle section approach. We'll talk about that more in a moment. And I call it the hybrid Lindsay model, and it's an attempt to call turns in the market on a schedule more frequently than Lindsay was concerned with. Lindsay's work, it can cover a cycle as long as 20 years, but usually he's looking at 6 month and 1 year and 2 year, inflection points in the market. In the hybrid Lindsay model, I think this month I've got 4 different inflection points listed in this month's report. Real proud of what I've done with that. It seems to work pretty good. It's not perfect, but it's pretty darn good. I would encourage everybody to take a look at that. The other part of the report is I take a concept from the Lindsay corpus and try to expand upon it. I try to take look at where we're currently at in Lindsay's models or using Lindsay's models, Lindsay's template, and try and show what's happening now, and then contrast that with how he used those models in history. For example, Lindsay took a look at what he created or defined what he called the long cycle. Let's see if I can do this. Dave, tell me if I'm going to get this right or not. Okay. I hope somebody can see this. Anybody can
Yeah, looks good. Yeah, I can see the chart. Okay. Also, I just want to tell everyone who's watching that I do have the Q&A app open. So if you have a question at any point during the presentation, just go ahead and type it in, and we'll get to those at the end of the presentation.
Fantastic. Thank you, Dave. This is what Lindsay called his long cycle. And you can see here he tracked this back to 1798. He did that prior to the Dow. He constructed his own index. And then, of course, what was it, 1896 onward, he used the Dow Jones Industrial Index. But the long cycle is approximately 20 years in length, and it is divided into two multiple cycles. Okay, so obviously roughly 10 years in length, each of those multiple cycles. And each multiple cycle is composed of anywhere from 2 to 4 basic cycles. And these dates he's got here are presumably the highs and lows of his basic cycles. I run the risk now of giving you too much minutia and losing your attention and having your eyes glaze over. So I'm going to try to avoid that. But back to this month's report. This month's report focuses on on terminal declines. Now, terminal declines are that point of the long cycle going from the final high to the last low. And it would probably be a lot easier to understand what I'm talking about if I pull up a different let's see. Here's his template for the long cycle. I'm going to assume everybody can see this unless Dave tells me differently. Each ABC, that is a basic cycle. CDE, there's another basic cycle, and A through E is one multiple cycle. So as you can see, ABCD is one multiple cycle made up of 2 basic cycles. From E to M is the second multiple cycle of the long cycle, and it is made up of EFG, that's one basic cycle, GHI, another basic cycle, IJK, another basic cycle, and K through M, a 4th basic cycle in the second multiple cycle. Now, most people have not heard of George Lindsay. Lindsay was a market guru from the 1950s, 60s, and 70s who never wrote his own book. He wrote a newsletter for over 30 years, and I was fortunate enough to come upon a big stash, for lack of a better word, of these newsletters and piece together what he was doing. Anyway, like I was starting to say, most people have never heard of George Lindsay, but a lot of you have probably heard of 3 peaks in a domed house. If you look very closely between K and L, that's exactly what we've got here. Lindsay said that in the long cycle, this is where we should see a 3 peaks in a domed house. Okay, so it starts to make sense. We have places where we expect that pattern to show up. I'm not going to go into any detail on the 3 peaks in a dome house tonight, but for those of you that have heard of it, that's where you expect it, or that's where Lindsay said to expect it. In my own work, I found we can also expect a 3 peaks in domed house right here. In other words, we're looking for this at the end of each multiple cycle. Long cycle is made up of 2 multiple cycles, and 3 peaks in a domed house comes at the end of each multiple cycle. Now, maybe that wasn't true prior to the beginning of the Dow Jones Industrials. You got to remember, Lindsay published his seminal paper, An Aid to Timing, in 1950, and which means he was only looking at market action from 1798 through 1949, and the market has changed somewhat since then. But I don't think I can quote him exactly, but there's a great quote of his. He says, people often ask me, the market's changed. How can this all remain the same? And he refutes that pretty stringently. And that's when we start getting into things, into his interval work. And that's another facet of the work of George Lindsay. Anyway, back to the report. This month's report deals with terminal declines because this is where we think we're in the current long cycle. The decline from J to M, which means we've got a big drop coming. We expect the three peaks in domed house and then another big drop. Where did it start? Well, this particular long cycle, we believe, started at the low in 2002. Let me tell you the 20th century track record on long cycles. It looks like we had a long cycle from 1921 to 1942. Now, everybody remembers the big crash in after 1929 through 1932. They don't remember it, but you probably know of it. And I'll bet you in 1921, everybody was talking just like they are now, looking at the low in 2009, saying a new secular bull market has started. Well, according to Lindsay's work, we knew to expect, we knew that the long cycle wasn't over. And typically, up until that time, and including that time, the long cycle had concluded at M at roughly the same level as A. Okay, now, then we had a new long cycle start, another roughly 20-year cycle. Now, this time, the long cycle did something very different. It ended, well, it went from 1942 to 1962. So the low in 62 was way above the low in 42. That was very different. I haven't seen that in any of the prior long cycles. I don't know if that's due to central bank shenanigans or exactly what would have caused that. Maybe the changes in technology and productivity. I just don't know. Won't claim to know. Then from 1962 to 1982, we had another one of these sideways patterns. I've come to call these alternating cycles bull and bear long cycles. That's my own terminology. Lindsay only talked about long cycles, but certainly in the 20th century, we've had what I would call bull and bear long cycles. All right. Then from 1982 to 2002, we had another one of these bull long cycles where the low in 2002 is way above the low in 1982. So if this alternating pattern continues, the long cycle that began in 2002 should end in roughly 2020, 2022, something like that, and should end at roughly the same level as the low in 2002, which means we got a long ways to go down from here. Okay. So anyway, once again, talking about the report, this month's report includes both information on the extreme short term, the hybrid model, my own hybrid model for calling very short term highs and lows, as well as a more in-depth, real-time look at some of Lindsay's bigger concepts. And again, this time it's the terminal decline that we're looking at. You know, how can we apply Lindsay's work most directly to our current market and come to understand it by looking at historical examples. And I've included a couple of examples from the past. Okay. There's a lot more to Lindsay than terminal declines. There's a lot more to Lindsay than just long cycles. But that's, I think I'm going to just cut it there, and maybe we can take some questions at this point. Dave, have we got any questions?
Yeah, I was going to ask you. So Lindsay's work was mainly focused on the very long term, but you can apply his patterns to multiple time frames, to shorter time frames as well.
Right. That's what my hybrid Lindsay model is about. Trying to take his methods, mainly the what he called the middle section approach, and combine that with more traditional cycle analysis, and come up with something that can give us. We can see it happen. We can set a date, and those dates for March are listed in the March report. Okay,
great. Yeah. Well, yeah. So for everyone watching tonight, Ed has been kind enough to let you guys get a copy of the Lindsay report straight from Timing Research. So I'm going to go ahead and share my screen here real fast. And if you'd like to get a copy of the March report, just go to just go to TimingResearch.com and click here on the new deals button, and click on the Lindsay report current month. And I'm going to go ahead and show the disclaimer too while we're talking about this. Of course, you all know this, but don't trade with any money you can't afford to lose, and be sure to read over the disclaimer when you have a chance. So when you go to the page, you can see some more information about George Lindsay and some more information about Ed. And the report is only $19.95. If you purchase tonight, you get it emailed directly to your inbox. And since the report is time sensitive, we are only offering this until March 22nd. And I do have a 60-day no questions asked refund. If you're not satisfied in any way, you can just let me know, and we will refund your purchase instantly. So if you scroll down to the Buy Now button, click on that, just a basic shopping cart, and you can fill out your information, put in your credit card information, and purchase, and you'll get the report instantly emailed to you. So I think that's it. Do you have anything else you'd like to add, Ed?
No, I think that's it. If anybody has any specific questions, they're welcome to come by the website. There's a contact us button there. You can also feel free to take what I call a sneak peek or trial subscription. Instead of signing up for a whole year, we give everybody a chance to just take a look at it for a month. And that's a good way to decide real quickly if this is for you or not.
And there's also a contact link on TimingResearch.com if you'd prefer to go there, and you can send me any questions or send a question. I can forward it to Ed for you if you want. So
there you go.
I think that's it. Well, thanks everyone for listening. We got a good crowd tonight, so hope you enjoyed the report.
Thank you,
Thanks,
Dave.
everyone.